Hey, everybody, I want to welcome you to the MrTopStep Thursday night webinar with Rob Booker. Real quick, I don't even know if Rob really remembers, but this is quite a long time ago. I called on him. MrTopStep was trying to do a foreign exchange room, and I had researched Rob, and everybody spoke so highly of him. But it's great hooking back up with Rob. FX is, one of those animals. It's really a difficult thing. It's the biggest market in the world, but yet um, you don't hear as much about it. It used to be that the hedge funds were huge in foreign exchange, and they made huge amounts of money in foreign exchange. But you never hear about the hedge funds heavily involved in foreign exchange anymore. It's kind of a weird thing. Maybe we can ask Rob a little later about that. But in the meantime, I want to introduce Rob. I want to wish everybody happy holidays and Merry Christmas, and I hope everybody has a very prosperous 2019. Rob's going to be coming in and talking about two indicators, but only one of them are they going to be marketing tonight. And then if people want, what I could do is come back at the end of the webinar after Rob is done. He said he's going to stick around and answer questions and do questions and answers. Maybe talk a little bit about the current state of affairs with the stock market and the Dow Jones and kind of a what's going on with the markets kind of thing. Anyways, listen, I'm going to hand it over to Rob, and Marlon, you're going to disconnect me, I think. And Rob, thanks for coming in. And again, I hope, wish you and yours the very best over the holidays.
Thanks so much. I'm super happy to be here. Hi, everybody. What I'm gonna do now is share my screen, and it will just take me a moment, and then we can double check and confirm that my screen is being shared. And then once we know that for sure, I'll launch into the presentation here, and we'll get this party started. So you should see a PowerPoint presentation coming up. Let's see if we can pull this back up. There we go. You should see a purple background PowerPoint presentation. That pop up on your screen okay, everybody? I'm going to assume the answer to that is yes. And if not, somebody will jump back on and let me know. Okay, I know your time is valuable, and I'm excited to share some things with you tonight on behalf of my friends at Noft. And I'll make this maybe as quick as possible. We'll get through this. I'll share some things that have been really helpful to me. And I usually talk about FX. And Danny, it's interesting you brought that up. I'm still primarily an FX trader. I'd love to talk about FX and what happened just this week or today even, and how it relates to everything else. But I've been asked tonight to present an indicator from my friends at Noft, and I love this indicator, so I'm going to be excited to talk about it. And so here's the deal. I'd like to share a few stories about success and failure in trading, and then share some simple charts. And maybe I'll go for 20 or 30 minutes, and if there's a bunch of questions, I'd be happy to answer them to the extent that I'm able to. And maybe then we could, Danny and I, or Danny in particular, could talk about what happened today and what's going on in the markets. As a matter of fact, Danny, the financial advisor that has the office next to mine was standing next to me at the bathroom sink today, and his entire face was pale and his eyes were just black. And I said, hey Brad, what's going on? And he's like, I haven't slept in a week. I'm like, what? Why? He's like, the markets. So I went back into the office and I realized the market was dropping, and I've already turned off my robots for the year. So I wasn't even aware of what was happening today. And then I had a great day of kind of checking things out and seeing how things were going. And I hope you're all safe. I hope you're all doing all right. Just as a beginning, everybody asks me what I'm reading. And so I'm reading these two books, or focusing on these two books right now. Jordan Peterson's 12 Rules for Life and Extreme Ownership by Jocko Willink. And then also Atomic Habits by James Clear. These books have been magnificent. I've been reading these November and December of this year. And I just want to recommend those to you. Of course, I don't make any money if you read these books. This is not a promotion. these books have just made a significant positive effect on my life, and I wanted to share that with you. Okay, here's the problem. Trading is hard, at least it was and can be for me often, and it can be very complicated. And at least it was for me. And I'm the reason that it got complicated and difficult. It was all me. The problem was with me. It wasn't with the market, and it wasn't with my indicators, and it wasn't with my charts, and it wasn't because of the broker, and it wasn't because somebody was running my stops. And I thought I was a victim when I first started out, of the broker, of the market, of the indicators, or not knowing enough. And what I realized was that I held the solution in my hands, and it was up to me to simplify things. So a lot of people ask me how I first got started in trading. Maybe you don't care, but I do want to share with you like how bad I was at this when I first started out. I was in law school in the San Francisco Bay Area, and this is what all of my professors' offices looked like. These people were just a total mess. Sure, they were smart. I don't even know if this animal is still alive down here, but this is what their offices looked like. Just a giant mess. And I realized no one's ever getting anything done in here. This person could die in this office and no one would find them behind the papers there. And it perplexed me, and it worried me. And I'm like, is this where I'm headed? Is this the direction I'm headed in? And then at lunchtime, I would go visit the offices of Bear Stearns down in the financial district at One Sansom in San Francisco. And here's Bobby Axelrod. And this is what a hedge fund manager's desk looked like. I used to just go to Bear Stearns, and I'll tell you why and how. And I used to just go through the hallways and meet the guys mostly that were clearing their trades through hedge funds at Bear Stearns. And with almost no exceptions, this is what their desks looked like. Simple, clean, organized, and they were just like focused. Doesn't he look like, he just looks, I'm putting little horns on him. He's like, he just looks mean. I love him and I love the show. And I don't even know what this is. This is some kind of booby trap safe here on his desk. I don't know, but I just loved it. And I fell in love with the lifestyle and the way that these people set up their lives and their business before I even fell in love with the markets. And I want to share that because I wasn't attracted to money or trading or the markets. What I was interested in was simplicity and a formulaic, systematic approach to the markets. That's why I trade almost everything robotically now. And every single time I trade a system that's discretionary, it has to be extraordinarily clear what I'm doing and when I'm doing it. So I started trading in the year 2000. My first business had failed. My business partner fled the country and moved to Uruguay, and I wanted to punch him in the mouth. And I had about $150,000 in business debt and about $200,000 in tax debt from that business. And in other words, I was totally screwed. And I thought, I'm going to get up and running as a trader. I'm going to make a ton of money. I'm going to pay off the debt and get my life in order. And I figured that that would take about a year or so. And of course, I found a photo of what I looked like back then when I was making this plan, and how organized I was. And it's going to really give you an idea of the kind of attitude I had about trading when I first started out. And that was me. Total smoking monkey, just completely deranged. And I had a completely giant misunderstanding about how this was all going to work. And I don't have a great story about how I started trading and I was natural and everything was okay from the very beginning. And maybe some of you are successful. And if so, I think what I'm going to share with you can even help further that. But I wasn't at first, and it was difficult for me, and it wasn't systematic. And I was always changing what I was doing, and I was mixing it up. And when something didn't work, I would switch to something else. And I felt like it was just chaos. I felt like I was trading inside of that law professor's office that was so dirty and whatever else. So I wasn't a floor trader. I didn't get an MBA in finance. I barely got out of law school. I went to a really good law school, but I was at the bottom of my class. I was the last student. I mean, they barely let me out the door. And I didn't work for a big trading desk at a big bank with the big boys. So I wasn't a floor trader. Well, actually, I was a floor trader for a little while. And here's a picture of me. I would trade a little bit and then I would fall on the floor. And then I would lose some money and then I would fall on the floor again. And that's my joke about being a floor trader. This is what my charts looked like. They were a mess. They weren't simple. They weren't easy. And I had been attracted to the simplicity of the way those hedge fund managers were treating the market. And they were doing, one guy was doing, he had a $500 million pharmaceutical hedge fund, and all he traded with biotech stocks in the stage 3 trials. And he was super focused and he was super organized. And then I did this, even though I knew some people in the industry, I was just messing around and it was complicated and I made it difficult. So anyway, hi everybody, I'm Rob Booker. And that's the beginning. That's the beginning of my story. It's now 18 years later. I've done 800 or 900 episodes of the Traders Podcast, and I have a really fast growing YouTube channel where almost everything that I do is absolutely free. I just ask that you subscribe. So I give almost everything that I do away for free. Occasionally I come on a webinar like this and I talk about a tool that I'm using, but the money doesn't go to me, it goes to the people that made the tool. And I'm just showing you what I like to use. And I hope that's helpful. I hope that, that's a transparent way of telling you what I'm up to. I went from blowing up my first trading account and making everything super complicated to being a commodities trading advisor with an $8 million fund in 2010. In that fund, I traded some futures and almost exclusively, though, FX. Today, I manage my own and my family's money, and I share stuff, like I said, freely on the social medias. And I do trade some futures. And I know some of you trade futures and stocks and whatever else. And I have a bunch of charts from the futures market tonight. So I love traders. And the reason is it was 2001 and I was in big trouble. And I knew that if I was going to succeed, I needed a different plan. And I needed some kind of plan, period. So I called an old friend and I found him on LinkedIn about a month ago when I was actually doing a webinar for Danny. And I found my old friend Ron Suber from Bear Stearns. And this is the guy who ran correspondent clearing at Bear. And that means that he signed up a hedge fund. They provided that hedge fund with an office inside of the building. And that hedge fund would set up shop in a small office and they would clear all their trades through Bear Stearns. And Bear Stearns would pay for their office and their phone lines and everything in exchange for clearing all their trades and making the commissions. And Ron ran that whole division. And Bear Stearns was a very profitable company at the time, run by Ace Greenberg, who was a weirdo and who thought he had an imaginary friend. I'm not even joking. I'm not even joking. He actually wrote a book and he featured his imaginary friend in it. But Bear was super profitable and very successful. And I got to walk around the hallways and meet these hedge fund managers because I met Ron and he kind of took me under his wing. So I called him in 2001 when I was going to start trading my own money. And Ron said, you got to simplify everything. And it took me a long time. It took me a long time to believe him and trust him and do that. But this is exactly what he told me. And success, to paraphrase badly Bruce Lee, you eliminate something. You remove the unnecessary. And every year, what I do at the end of the year here in December is I call all my credit card companies and even my bank, and I tell them I lost my credit card, and then everything that's on auto pay gets disabled, and then I've removed everything, and then I start January 1, and I only resubscribe to the things that I miss, and it's just a beautiful time. And then by December of the year, I've subscribed to all kinds of garbage and stupid things, and but that's you can imagine how great it feels to cancel all the stuff that's unnecessary. And then the only things I put back on auto pay are things like my utilities and stuff. So the second piece of advice that Ron gave was get a single-minded focus on one thing. Know what you're going to be great at and know how you're going to evaluate an opportunity. And an example of this is Michael Burry, right? From, I think it's Barry. It's not Barry, it's Burry from The Big Short. He was a doctor, Stanford trained, and he went into the hedge fund business and he shorted subprime mortgages in the mid 2000s. He was under enormous pressure while he did it, and he came out of it with a ton of money and a loss of a lot of hair and whatever else. But he knew what he was all about. He knew exactly what it was that he wanted to do, how he wanted to do it. And he withstood the pressure, which you and I always feel, because he had a single-minded focus. This advice made all the difference to me, even if it took me a few years to get it right, because I'm really good at complicating things. So tonight, in a few more minutes here, I want to show you a way that, in particular with futures, I've simplified my analysis. And once again, this isn't my indicator. I'm not going to make money if you buy this at like zero. These are my friends at Noft, and I do this because I use this tool. And so I want to show it to you and let you know about it. And we're going to talk about simplification along the way. So even if this tool isn't right for you, this idea of simplification and the way that we look at it, I think is going to be helpful no matter what kind of background you come from. So I'm excited to be here. I got about 10 more minutes of showing you like pure charts and hardcore technical geek out analysis, which I hope you're ready for. So if you're ready for it and you're excited about it, you can plug a yes in the chat box, and I'm super excited to keep going here. So let me know. And here it is. These red and green lines on the charts, this is it. This is the only tool I use when evaluating the futures market. And I do it because it's clean and it's organized, just like a hedge fund manager's desk. Now, my car, because I have young children, is like a moving garbage can. So I'm not some OCD person. Like, I can handle like dirtiness, but I like my charts clean, and I like to keep them simple, just like this. So I want to show you what these are made of, so you could just kind of, you'll understand the process, and you'll come away with feeling comfortable about maybe doing some of this analysis on your own. And like I said, it's clean and simple, like a hedge fund manager's desk. Now, there's good old Bruce, and there's good old Carl. Never met these dudes, but I sure would like to one day. Not because of, I don't want to learn their trading strategies. I just admire their single-minded focus and their tenacity. I don't know if you've ever thought about that, but all success, whether it's hedge fund managers or it's you and I or anybody in sports, it's all about tenacity. That's the whole thing. I just bought Michael Hyatt's 5 days of planning goal setting course. You've probably heard about it. And he shows this video at the beginning of this college runner, and she falls down flat on her face when she's in second place. And then in the last lap of a 400-meter race, she from all the way after falling down, she goes in front of everybody else and wins the race. And that's about tenacity. She just crushes it. And I have so much respect for that, because that's what it is. That's what it's all about. So what I do is I have these lines on my futures charts, and this is NinjaTrader 8. And these lines are made up of order flow. And I'm going to show you what kind of order flow they're made up with. And then what I layer on top of those are swing highs and swing lows. So these dotted lines are swing highs, and these dotted lines are swing lows. That's all I have. So that's what I do. So what these red lines represent are areas where, if you look at the depth of market, these are areas where all of the buying orders are falling off. So maybe there's 200 orders, there's 100 orders, and then there's like 10, and there's a giant drop off. So from one candle to the next, maybe there was 200, maybe there was 100, and maybe there was 50. And then all of a sudden, there's a significant and substantial drop off from that buying volume. So all those orders are just dropping off. And these lines appear when those orders are dropping off. Now, these green lines appear when those orders are coming back in. And it's a way of looking at supply, like literal supply and demand, where the orders are. And it's a visual representation of it without having to look at this kind of stuff, which is great, but I don't want to complicate my charts with that kind of stuff. I want to simplify it. So I'm just simply looking at order flow added to swing highs and swing lows. That's all I'm going to look at. And I'm going to show you a bunch of charts and trade examples so you can kind of see what I'm doing. And hopefully, like I said, even if this indicator is not for you, even if it's not a great fit for you, the principle behind the simplicity, I think, is what we're getting at. Okay, so here we go. This this short early warning. It's an early warning that the market wants to drop. So that's number one. So as soon as that appears, I've got an early warning that the market wants to drop. And then what I'm going to do, because this indicator plots the swing highs and lows, it plots this line right here, and it's waiting for me. And it's an old swing high. And as soon as I get the early warning sign, and then we hit that swing high, I'm trading on a limit order. It's a limit sell, and I'm selling, and then I've just followed a really super simple system for getting into a trade. Excuse me. And then my targets are old swing highs that are now support, and old swing lows, which are naturally support. So the principle here is early warning sign, hit a level. So 1, 2, 3. Simplicity. Support and resistance zones don't have to be magical, and they don't have to be made up of some, these people that get on webinars and stuff, and they say, well, this is made of 2 quarts of, verifiable dragon's blood and the navel hair of a dead witch, right? And they tell you some kind of garbage. These are just swing highs and lows based on, simple price action. Like, let's not get crazy. And it's so simple, and yet it's so powerful. And for so many years, I made things more difficult. But just pure bounces off of resistance and a trade down to support is just beautiful. And if I add to it this early warning because the buying is drying up, it's that much more beneficial to me. So here's an early warning sign that the market wants to go up. And that's not an immediate entry signal. But when we drop down and hit that swing low, these are buy trades. And I can place my stop just a little bit lower, just a few ticks lower. And then I can place my profit target up here at a recent swing high, which is resistance, or an old swing low that is now resistance instead of support, or even something higher. I can take half my position off here and then half my position off here. Sometimes I only take half my position off when it drops, and then I hold on to it for a little bit more, and then I add to it as it goes back up again. Here's another example. Here's an example of the market saying, oh, hey, I want to go up. And then it just immediately goes up. And then only later at a higher low, this is just beautiful, a higher low, it drops and hits a swing low. And boom, it's like liftoff. It's just, so simple. It's so easy. And all this is, once again, it's order flow analysis. That's all that is. That is this stuff right here displayed only when the orders are really dropping off. Only when tons of orders are dropping off here and the buyers have just dried up, or when the buyers are coming back in. Here's another example. Here's an early warning sign that price wants to drop. And then there's a hit of resistance and a small drop if you're going for a few ticks. This is a 5-minute chart on the YM. I like YM. I like the NASDAQ. I like gold. I like oil. Love oil. Love oil. So there's a few ticks there. And then you might stop out. But then later on down the line, we might see this example. It does a really beautiful reversal back lower. Sometimes you get 2 of these signals not so far apart from each other, where the market is basically just barely climbing and struggling to make higher highs and higher lows. And these are beautiful, beautiful opportunities. Maybe this is a stop out right here, but then this isn't, and it makes a double top, and then it just craters. And I've noticed that sometimes the seeds of wealth are disappointment, that here's how trading goes. Step one, get disappointed by what happens. Step two, get revenge. And you think you're not supposed to do that, but you are. Here's how it's supposed to work. The first trade that I take when I take a discretionary trade is usually quite small. And it's like a rubber glove position. You slap on the rubber glove and you do a little probing. And then if you don't get if you don't find what you're looking for, it doesn't matter. And then you come back in later. Sorry, that was a really crude example. But later on, you can come back when the trade's really set up and you can really pile it on. And most people lose all their money on the first trade. And they're not testing the market for feedback. Here's some examples of signals that price wants to go long. And let's say you went long here when it dropped down to a swing low and that failed. That's an example of what I'm talking about. Sad face, and people go, oh, that doesn't work. Or I say it doesn't work. That's what I do. I go, it doesn't work. And I say some terrible, nasty thing. And then it just bounces off of a swing low the next time. And I've got to be ready for that. So oftentimes failure is actually a positive thing. And that sounds crazy. Here's another couple examples of signals that the market wants to go long. Then it drops down, most likely was divergent. And then it takes a couple times. Maybe you stopped out on one, and maybe it comes back on two. Don't mind it at all. Don't mind if I do. Here's another example. Two beautiful signals that the market, that the buying is drying up. And maybe it can make a few more highs and shake out all the people before it goes low. I mean, this is what happens. Hey, everybody, the order flow is dropping off. Just kidding. It actually wants to go up. Just kidding. We were faking. And then, but it does. You get the right idea at the wrong time. You get the right signal, but it's the wrong time. And so what if a stop out was actually a super high probability setup in disguise? I call losses big trade early detection machines. Here's why. Let's say that this is a signal that the market wants to go short. And let's say I stop out here. And let's say I get a trend line in place and I wait for it to hit the swing high again. And then I sell it here. And then I sell it again. And then I sell it again. What if I add to a winning position instead of adding to a losing position? What if I give up on it here and I say, I'm coming back for you 40 minutes from now, 2 hours from now. I'm coming back for you. Here's another example of there's a buy trade that sets up. And then here's two swing lows right next to each other. I love when the market locks in two swing lows right next to each other. And here's a short signal hitting a swing high. Here's a buy signal hitting a swing low. And it just goes back and forth. I simply look for trades and then take a 1 to 3 risk to reward ratio. Get in here. I drop my stop down below the lows. And then I just say, all right, well, this is, let's say 10 here. Then I'm going to go for at least 30. I want there to be at least 30 up to the nearest swing high. So this is all this mumbo jumbo. I want to help you get the stuff on your charts if you want it. Like I said, it's not mine, it's someone else's, and I love it. So here's what I've got for you. I'm doing this for Christian and the folks at Noft and Troy, my good friend. Here's what I've got for you. They've got an order flow training class that I did. I did this class and I loved it. I loved this class just for the analysis on order flow. It was brilliant, super simple, broke it down. Then NinjaTrader installation, they had Mark get on because I hate installing my own software, and he installed it on my computer. And then I got this order flow analyzer, which looks like this. This is all the deep stuff and they go into super geek detail on that. And then they also do the order flow pattern spotter, which is the simpler version of it, which I love. And they give you those indicators together with it. So I asked them if they would do a money back guarantee because I don't like getting stuff and then not being able to try it out and seeing if it's right for me. And I figured you'd probably be the same way. And that would make me feel comfortable if you felt comfortable. So by now, you know, I love these indicators because they simplify my analysis of the futures market. So I'd love to send you my analysis every time I do it too. So if you're on YouTube and you want to see, you know, I use this stuff from time to time on the YouTube channel. So check it out. It's all about spending less time in front of the charts and more time in front of whatever it is that you want to be in front of. That's what it's all about. So here's the link, robbiebooker.com/order flow, and that will redirect you to a page. And they have these for 99 bucks. So they usually sell them for more. But what we did was like I said, we cut out the profit or commission or whatever you want to call it. And they just give you the tools and don't have to mark it up or whatever. So if you click on that link or you go to that link, you'll go to this page that's like 4 miles long, and it's like War and Peace ×7. It's like a Jane Austen novel. But you scroll to the bottom and you can do it. And all this whole thing does is it's a long-winded explanation of everything I just said. And then when you get the class and the indicators, you get a really super organized set of lessons. There's 10 in all, and the indicators to install. So that's what I've got. You can go to robbiebooker.com/order flow, and you can get all that stuff for 99 bucks today. And I just really appreciate you letting me make that, you know, little explanation and that pitch for my friends. That means a lot to me. And it's back to you all. I'd love to talk about what we saw in the markets today, Danny, or just hear what you have to say about what we saw. And I'll just turn it back over to you.
Okay. Hey, Rob, great job. You know, one of the things I enjoy about your webinars, and you can hear me, right?
Yeah, yeah.
Okay. One of the things I enjoy about your webinars is you do it and you seem so happy doing it. And I know you've done it so many times that you probably like want to shoot yourself in the head, but you know, you seem to have you know, you're really good at it. You really are.
Thank you very much. My true calling is entertaining people and telling the truth. So
right.
I found that I love showing my mistakes, and every once in a while I have a successful thing. But I love this. I love this exchange between you and I
Yeah.
love hearing from the haters on YouTube and engaging with them, and
Well,
I just love the whole thing.
You know, you made some remark about you know, some kind of magic indicator or something, you know, and that's really the truth. You know, I think that simplicity goes a long way. And for a lot of folks out there, they're just, you know, they have certain ways that they look at the markets, and they, even though they listen to what other people are kind of saying and doing, and even though they hear it works and it's successful, you got to really, really give them a push to try to get them to really jump on board. And I think that I think your presentation was good enough. I think that some people, if you were reading off to the side, some people actually asked you a question. Did you see any of those questions?
No, I didn't. I don't think I had access to see the questions, or I was being super ignorant and not looking.
Okay, well then let's see. Let's see.
Yeah, I can see them now.
Okay, okay. The names of the 2 books.
Oh yeah, sure. So I'll type a message while we're talking.
Okay.
With the names of those 2 books, 12 Rules for Life, and then also Extreme Ownership.
Yeah.
And then I also loved Atomic Habits. I just taught a webinar to my, you know, I don't want to call them students or whatever, like my tribe on YouTube and whatever. I just taught a big lesson about habits today. And I'm just obsessed with this idea that we do most things on autopilot, right? We're just kind of walking around, just like doing stuff on autopilot. And trading is one of those things. Like, it's like, I don't know why I'm doing it anymore. And if we stop and consider what we're doing and how we're doing it, and make a thoughtful, habitual approach to trading, it's like one of the easiest things you can do that immediately improves your trading. So I loved that book, Atomic Habits.
Yeah, I agree. I actually have a copy of that, and I've read most of it, but I do. It's a good book. I didn't get it all done, but anyways, Marlin was going to put up. You know, we've been around the market so long. We don't need any kind of prompting or anything like that. You know, I mean, this is going to be totally impromptu. I asked Marlin to pull up a couple of charts.
Sweet.
I asked him to pull up the gold chart, the let's see, the crude chart, the ES, and the NASDAQ chart. And you know, one of the things that I think about all this is that as the credit crisis unfolded, and when I was on the floor in 2000, you know, during 2007 and 2008, I had a very, very unique perspective of what was going on at the time. You know, I was working with Marty Schwartz, and who was a very, very studied guy. And even at 73 years old, he's probably one of the largest independent traders in the world. And he used a term back then, and he told me this one day, and it was after the S&P had made a high and the market started selling off, and he said, you know what? He said, there's rotten wood floating around in the markets right now. And I said, what do you mean? He said, the market leaders, the brokerage stocks and the bank stocks are weak. And back then, obviously, the brokerage stocks were much more important than they were, you know, they were much more important back then than they are now, because brokerage firms there's less of them and they're much more regulated. But anyways, I remember Marty talking to me about, this is a NASDAQ chart that we're looking at, and it shows the high. I think right now, I'm not sure exactly what, maybe Marlon maybe the chart will show us, but I think.
Can you hear me, Danny?
Yeah, I can hear you.
So that's October 1st is the high. So we hit the high right around October 1st.
And so can you give us a percent of how much we've sold off since then?
I'm still trying to figure out how to use these tools.
All right.
So down at that bottom of it yesterday, that was down 19.9%.
So 19.9% since October 1st. Is that what it was?
Yeah. That's 59 trading days. So
right. And I mean, here's the thing. One of the, I believe that when I'm talking to Marty, and I know that he's been around every crash, you know, in the last 45 years. I know that I've been around every major move since 1985 when I started on the trading floor at the Merck. And there's a lot of comparisons being made about this decline being similar to, say, the 1929 crash or the tech bubble. And to that, what I would say, or even the 87 crash, to that I would say is that during those periods, and I'm not saying that there weren't bear markets associated with the big sell-off, but during those periods, the market eclipsed at a high, and then in came a major sell-off. What's happening now is we've just recently made contract highs, and over the last 2 months, we're going down almost every day. And we haven't seen something like that. And the extreme level of volatility, and I've talked to Marty about this, and I said to him, I said, we've never seen anything like this before. And he said, absolutely not. He said, you know, no matter what anybody says, we've never ever seen this high of volatility, or this large of volatility, or this sustained amount of volatility for so long. Anyways, what chart are you pulling up now? That's the S&P. All right. All right. So our high was on.
So that high looks like it's right around 21st of September.
Yeah, that's right. And to the current low that we made today, how much are we off?
Hang on.
So that was September 24th, right?
I think it said the 21st, but I can't remember now.
21st, that's all right.
And that's down 17% over
Yeah, that's what I thought, down 17%. So September
64.
21st, November 21st, December 21st. So in 2 months, we've sold off 17%. Is that fair? Is that a fair thing to say?
Yeah.
Okay. I don't think I've seen anything like this for a while. Okay, if ever. Now, can you put up the crude oil chart?
Crude oil, sir.
Yeah, and is Rob still around?
Yeah, I'm here.
Okay. But jump in anytime you want, Rob. Now,
Yeah, I've been thinking the same thing. You just said the same thing that I've been thinking, is that this kind of sustained move day after
volatility.
day after day is
Yeah,
taking a lot of people by surprise.
yeah. And I think hurting people too. I think
Yeah.
that even though these are the days that, you know, people say they live for, they live for this maybe once or twice or three times a week. They don't expect things like this to go on for
Yeah.
3, 4, 5, 6, 8 weeks. Or, you know,
Yeah.
when's it going to stop? I don't really know. I don't know.
Well, I had some call options that expired on Monday of this week, and I was, I was as sure as you could possibly be, Danny, that those
yeah,
S&P options
yeah,
were.
yeah. Will
It,
you?
it was exactly the pattern that I've traded 100 times for a bounce,
Right.
and it didn't work. And I was
No.
like, okay, well, I lost like $500 or something, but I thought,
Yeah.
wow, that should have worked. It felt weird when nothing bounced.
Right.
It's like there's nothing. What was the floor and where did it go?
Yeah. Well, this is the new thing.
Yeah.
I believe, and I remember what we used to think on the trading floor, and things have really changed. But it, what would happen is, even in the S&Ps, everything would build up, and then they'd have a crash, and then everything would, like, the business would die out. It would take months or weeks, months to rebuild the business. And one of the things that we always did, even though we did like Tudor, Bacon, Kovner, Soros, all those big guys, even though we did all those big accounts, we also did a lot of little business, because I had a thing at the desk. If you got 6 guys at the desk and you're paying their salaries, I always had a saying: you do the retail, because the retail trades all the time, and the big stuff doesn't necessarily trade every day. They may put them on and hold them for a couple of days or a week or whatever. Whereas the retail guy, and back in the day, the retail guy was trading the big S&P that was, $500 a point, and
Yeah.
guys were coming in and out of our desk, and they were trading 10s, 20s, 30s, 40s, by 50. A retail guy, and it kind of unheard of. You wouldn't think you wouldn't think that today. But anyways, I've seen these kind of times when you get, extended bull markets, and I think you've been around for a couple. I mean, you were around. Were you around before '87?
I was around on planet Earth, but I was in '87.
How old were you in '87?
My sister was dropping. No, I was 15 and a half, and my friends and I would stop at the thrifty drugstore on Alicia Parkway in Mission Viejo, so I could buy the Wall Street Journal before school, and everybody just rolled their eyes.
Oh yeah,
I was the stupidest, the biggest nerd. So I was reading everything all the way through that decade.
Well, I'll tell you what, that's a good. I read the news. I read the Wall Street Journal every day, so it's a good one. But anyways, let's move. Hey, Marley, can we move to the gold chart?
Well, just this oil is phenomenal chart.
Oh, the oil. Yeah. Okay. This is the oil chart. Okay. All right. Let me back up. About 2.5, 3 months ago, I went on Periscope in the afternoon, and I said that crude was topping out, and I said around the 74, 75, $75 level. It got up toward $76, 76.02. I can't remember the exact time. And then I said it would sell off, and it has. But back about 2 weeks ago, there was I think it was like right in here, if I could get the pointer. there was an uptick where the crude oil rallied for a couple of days and it shot back up a little bit. And I went on Twitter and I said, look at, the Russians and the Saudis are pushing for, production cuts. Well, I don't think that's gonna help very much. I think crude oil is going back down to $45. And here's the thing. Now, this story is good because we see this as a positive at the pump. Like my wife even said it. In Chicago, a gallon of gas was like $2.49 or $2.59, and down here in Florida, it's $2.19. And I explained to her that crude oil had dropped sharply over the last several days, but I don't think this story's over. I think there's more to go on the downside. Now, the negative to all this is that we all know when crude oil went down to what, $35, there was a lot of fracking companies in the United States. A lot of people lost jobs. I think they say under $50, some of these companies start losing money, but under 45 or under 40, we know that they're going to start really losing money. So there's a good side to this and there's a bad side to this. So anyways, Rob, what's your opinion on crude oil?
Same thing. It's one of my favorite ones to watch because it's the one that has the greatest number of hopeful opinions. And if you stand on the sidelines and you watch it go down, there's the people in the production cut camp, and then there's the people in the conspiracy theory camp, and then there's the people in the solar energy and wind power is taking over the earth and oil is going to go to zero camp.
Right. Yeah. No, I know. Yeah.
And there's people arguing so strongly on both sides, and so as an objective viewer of all of that, I just love to see that go on in the midst of these enormous swings. And if you spend a lot of time arguing about the why, you miss the trade. Like there's so much here to do technically. There's so much here to do on oil because it can move 40% in what, a month and a half?
yeah, that's exactly right. That's what the Wall Street Journal had about a day ago. I remember that.
Yeah, right.
But I think when things bleed like this, as hard as crude is bled, at least the way I look at this chart, it doesn't look like it's bottomed yet. Can it bounce? You're always a little bit hesitant to get real negative after a big sell-off like that because you know that the algo's got to do their thing and run some stops at some point. But I think that there's more downside here in crude oil. And I'm not sure. Maybe they mark things up a little bit at the end of the year.
Yeah, and then the biggest bounces are going to happen. The most volatile bounces are going to happen in the midst of these like really, really sharp declines, and that's going to keep a down market is like really hurts people. Not just because it's going against them and their buyers. It hurts even the short sellers that come in now, like people that get really enthusiastic about shorting it now, and then they just get blown like all in one day, and then the downtrend can continue. But you don't see, like, when the market for so much time just gently and easily keeps going up, it lulls us into this sense of security, and we don't, like if we have a February volatility crush or like a Chinese flash crash, or we see these every once in a while, but this is a bear market, and so it's a whole different ball game now. Like the whole way that you trade this market changes. You don't just like buy the dips. You don't ever do that. In fact, you just wait for people to get super enthusiastic inappropriately. You wait for the bulls to go, this is amazing.
What did the Fed say over I can't remember those famous words that Ben Bernanke said. Over exuberance.
Irrational exuberance.
Irrational exuberance. That was a good one.
Yeah.
Now let's see. One thing, we got a question from Jim. What have you found in the correlation of CL to equity index? If CL hits bottom of 40, does that mean that the indexes will stop the drop, or can the index go much further than CL, which has a limit of how far it can go down or it can go? That's a good question. I'll let you answer. I mean, I believe there is a big correlation between crude oil and the S&P, but go ahead.
Yeah, you got me there, Jim. Great question. I don't know. I have no idea. Like, I could talk about trading them individually, but that correlation question, that's definitely not something I've ever thought about.
Yeah, well, there's a lot of traders that do believe there is a big correlation.
Yeah.
And obviously, if you're trading the S&P, 6% of the S&P is energy or oil stocks. So there is a correlation, but I think
I look at the Canadian dollar and oil, and the Canadian dollar can't go to zero either. So what will happen often is that oil will go further than the Canadian dollar. Like, oil leads the Canadian dollar, and I wouldn't be surprised if that's a similar arrangement, even
Right.
though, So what I found is, like, oil will go down, it'll stop, and then the Canadian dollar will, like, keep sliding past it a little bit. Like, it'll be like, I'm coming, I'm catching up. So,
Hey guys, we have some viewers on YouTube Live too, and there's some questions there that you guys can't see. So Corzine asks Danny whether you think we can get a equities bounce here, and then with more downside.
To answer your question on that, first of all, I think everything is really, 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 there's just an abundance of negatives out there, and they seem to continually be they continue to pile up. A lot of times in the past on these big, the big thing about the dip buyers over the last several years, we'd get a pullback of 40 handles in the S&P. We'd get a pullback of maybe 60. I used to say that the average pullback before the market started kind of slipping last year or early this year, that, like an average pullback from a contract high was like 40 to 60 handles. Occasionally you'd get a $100 handle pullback, and that would take several days. I mean, that could take a week and a half. And in this situation, I think that the global economies, we've had this huge bull market run, and I hate to repeat myself over and over, but in March of 2009, the S&P made a low, and we're December 20 of 2018. We're 9 years into a bull market that has pushed up the S&P over 335%. And do I think that this situation was going to happen at one point or another? I do. The good times have been rolling and rolling and rolling. And I think that, I don't want to get into the politics side of this, but I think that Trump helped push this a little bit. This was kind of he's proud of his rally, but he's also trying to push to get these tariffs, out of the way and get this trade war stuff done. But there was an article in the Wall Street Journal, in fact, a couple of days ago, that said that 4.5 million Chinese people will be out of work next year. Now, do people in the United States care? No. But when 4.5 million Chinese people are out of work, that means that it's going to be a big, big part of a global slowdown. And I think the big thing about what's happened that has been the main driver of the upside is all the quantitative easing that was going on. And Europe just cut back from, stopped doing its quantitative easing. The United States quit its quantitative easing, has been raising rates. And at the same time, the Federal Reserve is paying back $50 billion a month. It's sucking liquidity out of the system. So to make quick of your answer, I do think that there's a bounce coming. I don't know if it's going to be before or going into Christmas, or the Santa Claus rally, which is usually the last couple of days of the year, the last couple of days after Christmas. I think there's going to be. In fact, I really thought today that there was going to be a low, but then the S&P did exactly what it does every day. It rallied early in the day, and then it sold off hard. And that's really the basic pattern of what's going on. And the Pitbull's got a trading rule about bear markets. He says that they rally early in the day and early in the week. And if you look back on this over the last couple of weeks, you'll see that the S&P was probably down in the morning and then had this big rally and then just sold off. And I want to say one thing before I kind of move on to the next question. I'm rather concerned about this. I think that, what happened on Wall Street back in the credit crisis, there was a big financial party, and you or I or anybody else probably in this webinar or on YouTube right now was invited to that party. Everybody was trading up a storm. JP Morgan, Goldman, Bank of America, my buddy Raj, everybody was making billions of dollars. And when that all came, when the music stopped and the credit crisis started to unfold and he had all that subprime debt, I knew we were in trouble. I saw it on the trading floor. I could see it, the looks of all these different people around me and the types of orders that were going. We did all the AIG business during the credit crisis. Their book was gigantic in the S&P. And by the time 4 or 5 years into the credit crisis, you know how big the S&P book for AIG was? It was down to 12 big S&Ps, 12 lots. And they would still call the desk and ask us if we wanted to do the spread. They I don't know if they didn't do it electronically or not, but they just always continued to use the desk right up to that thing. Now, here I'm going to say one last thing. I'm not an economist, but I am going to tell you one thing that we all knew when we went into this stuff with the QE, and everybody was told that it was going to be a short-term Band-Aid and that there'd be hell to pay at some point, or at least I said there'd be hell to pay at some point. And I think we're seeing that hell being paid right now. All this liquidity being sucked out of the market, up 335%. You got Italian debt still not settled. You got Brexit. You got the Fed in the United States that seems to be fumbling. At least
you got a trade war. You have trade war. You have political. You have political problems, which are always the source of currency problems. It's not economic. It's always political. It's a lot of things at the same time. Yeah. And also, Facebook can't possibly be worth as much as what it was trading at.
No.
Also, there's just things
well, we're going on 22 trillion in debt too. I mean, but nobody cares.
Hey, Danny, I'm gonna go help put the kids to bed. But,
all right, no problem, Rob.
Yeah, it's really great to spend some time with you. I really appreciate the invitation.
Spending time with you too. I got all my charts and stuff this way. I'm kind of my wife put me in a closet. It looks like you're in a, well, you're in a room.
I'm in my wife's office.
oh, nice. All right. Well, listen, Rob, you have a good evening and thanks for coming in.
Okay. Hey, see you later, everybody. Thanks so much.
Thanks, Rob.
And then, hey, Marlon, can you push up the gold chart?
I can.
Okay. And then, okay. Now, gold. I'm not a big metals guy, even though I worked on the Chicago Mercantile Trading Floor along Riverside Plaza. I was in the gold pit as a clerk when I was first started out. And God, did they rip everybody off back then. That was unbelievable what was going on in the gold pit at the CME back in the day. I mean, they'd have these $20, $30 opens or $20 opens. One guy would have 500 to buy. One guy would have 700 to sell. One guy would buy the high of the open. One guy would sell the low of the open. The guy in the middle made just all this money. He was so dumb, though. I mean, I don't think anybody ever held on to any of that money. It's a travesty. But anyways, one of the things I've always been kind of enamored with is that gold seems to be very trendy, very cyclically. It goes through cycles where there's interest in the metals market. And then it goes through periods of time where there's no interest in the market. And then when there is interest in in the metals, you've got these crazy TV shows where the guy comes on and says, oh, make sure you got gold in your retirement or your silver bars in your retirement. And I run into people, I'm not going to mention, who, but I know, I don't think she has a lot. But the lady that sold me the house here in Florida, she told me one time, I've been buying some silver bars, and I had just seen one of those commercials on TV, and I thought, man, you know, I don't know when gold is really, really, really going to come to roost. The metals are going to really come to roost. You know, I was there when they went from like, when gold went from like 250 to like 650. That was like that was like a historic move. You know, I mean, but now gold has gone all the way up to over 2000, gone up to over 2000, and it's settled back down, and it's really settled back down around the $1,200 level. Now, back about 2 or 3 months ago, or a little about 3 or 4 months ago, gold's traded up above like 1210 or 1220 or something like that, and everybody got the gold bug again. And I went out on Periscope and I said, don't get the gold bug. You know, I said I think gold's going back down to 1150, and it went back down to 1185. But now in the last several weeks, as the S&P has stumbled, and maybe it's playing out at a risk play or a flight to quality. I don't know. You don't hear a lot. You don't hear that term a lot. Flight to quality. Maybe people are moving out of stocks or moving out of riskier assets and going into metals. I think that's what it looks like to me. But it got up to 1264. Marlon's got it on the chart. It got up to 1264.90 today. I mean, I don't know if that's the high of the day, but this is a gigantic move for the metals market. And I watch copper, and I watch aluminum, I watch gold, and there's been very, very little participation in the metals markets over the last several years. But it seems like, and not a lot of talk of it, that the metals markets are coming back into flavor, and that's good for you metal traders. I'm not a metals trader, but currently, if you said, well, what would you do at 1265? And this may be wrong, I wouldn't be trying to sell this stuff right now. It doesn't look like it doesn't look like maybe you can make $4 or $5 on a sale here. I don't think gold's topping out right here. I think if you look at the chart, it really, if it's really good, you can get back like to the 1310 level. And I know that you hate to start talking higher prices in metals after they've already gone up, because you don't know how much of the leg is left. But Marlon, do you ever look at the metals, Marlon? I don't know if Marlon's still.
No, I'm sorry. My mic was muted. No, in fact, I had to ask you what the symbol name was.
Yeah.
I don't really. But it's interesting that it poked its low kind of like that mid-August area. Kind of like, capitulated there, and now it's just kind of being running up. And I was kind of surprised. It's only up 9%. I think it would kind of mimic a little bit on the downside risk of the.
Right. Well, I mean, maybe as people moving, there's a lot of tons of money moving into bonds. So, as people liquidate stock, they look for alternatives, and gold's obviously an alternative. But here, can you do me one favor? Go back to the, I want to look at the S&P chart real quick, and then the NASDAQ chart, and I'll take like 5 minutes to go over both, and then we'll call it a night. But anyways, so the high of this is the S&P chart. The high was back on, what was it?
Oh, it looks like it kind of double topped here. So September 21st is the high, and then it tried again on October 3rd.
Okay, all right, and that was around the 2930 level, right?
Yeah, that's
2945.
2947. It looks like.
Okay, all right. Well, so it's 2947, 2945, down to today's low.
And today's low, I think this is the continuation. So this is today. The low is 2441.50.
So how many handles have we
right?
lost?
That's not right. That can't be right.
No, that's not.
Because I see it down. No, 20.
Yeah, it got down to 42. Got down to 42 or something.
41.50.
So 29.47 down to 24.42. So we've lost over 500 handles in the S&P since September 21st.
Right.
That's a lot of wood to chop. I mean, that's a lot of, that, you know, like I was saying, the funny thing about this is it seems to be, no one seems alarmed at any of this. You know, the Dow down 800. We talk, Marty and I talk about this all the time. It's like Dow down 800. Doesn't anybody care? Is this normal? It's like Rob said. Is this the new normal? It seems to be. And then the NASDAQ chart, if you could. And this is, you know, I don't know what to say about this. I mean, this chart, and I'm not the best reader of charts, but it looks to me that if you had a feeling that the market was going down, and you just sold the rallies, you've made oodles and oodles of money. If you just forgot about trying to be smart and pick these bottoms, and just laid back, let the NASDAQ rally after it sells off to a low, let it bounce and sell it. You almost, it looks like you would never lose. I mean, maybe you came in early and you got stopped out, but to me, this is a very, very bearish looking chart. And I don't think it's done. I just don't. Can the S&P bounce a little bit? Going into the end of the year, sure. Can it bounce a little bit in the beginning of 2019? I guess it can. I mean, we're down 500 points in the S&P, or over 500 handles in the S&P. So we're due. But I just think that there's a big dark cloud following this thing around right now, and housing's part of it. I talked about that on Periscope yesterday. You know, new home sales, these housing numbers are horrendous. They go all the way back to the weakest numbers of housing numbers, all the way back to 2002 and stuff like that. So, you know, this is nothing to be fooling around with. I know that a lot of people are a little bit, I wrote about it in the opening print today, that I think that people are still a little complacent. They see what's going on, they shake their head, but they say, hey, you know what? The S&P's rallied 3,000%, you know, up 30, you know, up 350%. And I can give back a little, but I don't think so. I think you got to be smart. If you going into the end of the year, I mean, there could be a little bounce, but there could be a lot of tax selling related to all this tech stuff that's going on. So anyways, listen.
There's a couple other things too. It just, you know, first of all, there's going to be funds that are going to go belly up here.
Oh yeah.
Always happens at the beginning where there's a big move. And then what you see too is you see the corporations take advantage of this and start writing off their bad debt and get everything bad and debt off their books. So you can start to see a cycle of bad quarters and write downs. So that's going to be adding to the tailwind here too coming up.
Well, the other thing is, when all that quantitative easing was going on and you had zero borrowing costs, you had record, buybacks, and then now they're predicting that the buybacks are going to really, really drop, and that's not good. That's been a main driver of the upside in the stock market. But anyways, Marlon, I know that we had Rob Booker on tonight. As always, I think Rob's a very interesting guy. We've got our stuff coming up. I'm gonna try to talk to Morgan a little bit and see if we can't get Rob back one of these days. But
we'll get him back. We're gonna get him back in the boot camp. So
okay, good.
We'll do that there. So a couple things, right, guys? Go to our website, MrTopStep.com. Click on that Hey Hotshot, and you guys tell us what you think the ES is going to do at the end of the year. And if you're the closest, you'll get $250. So
yeah,
and, 250 is nice, but bragging rights is even better. So
well,
you want to do
that. If they got a date on New Year's Eve, we can make sure that we can get them the 250 if we get the numbers. So if somebody hits it, we can make sure they get their 250 on New Year's Eve. Okay, now what else we got going?
And the other thing we talk about is January 22nd, we're going to have a boot camp. So we don't have any ads up for that, but just kind of pencil that in, save the date, 22nd, it's Tuesday, and then whatever, 22nd, 23rd, 24th.
Right. And what just so we're gonna have Raj in there. We'll have Kevin from Peter Stottlemyre, the guy that did Market Profile. He was Peter Stottlemyre's clerk, and we're going to be offering classes. Raj teaches options classes. He's great. Kevin is probably one of the best in the world at market profile. But we're going to have a lot of really interesting people coming in. Marlon, you said that we're going to do just a 4-day boot camp, though, right?
It's 4 days, yeah, because that Monday is Martin Luther King Day. So
That's right. So, and again, I want to tell everybody that we don't charge a lot of money for the boot camp. I think it's like $19 or something, and with a coupon, it goes down to $12 or $13. But it's a great time to come in, hear what other traders are saying. You'll have the MIM. Marlon will be coming in and talking to MIM, and the MIM has really been something in the last couple of days, Marlon.
it is.
You
Yeah.
know, we get these big, 1.8, $3 billion MOCs. What happens? The S&P sells off, and then all of a sudden, the MIM starts to move the other way, going into the 3 o'clock cash close, and up go the futures. Kind of a typical trade that we've been seeing with the MIM recently. But
Yeah,
anyway,
we open all our doors. So you'll be able to IM Pro, MIM, you'll be able to do PTG David. So the Polaris Trading Group and the Discovery Trading Group are going to be all available to you too.
yeah, and there'll be a lot of presenters, and there's a lot of different forums in our room. But anyways, listen, Marlon, thanks a lot for coming in tonight.
Thank you, Danny.
Yeah, it's been recorded. Listen, let me read one of these. It says, is it possible that the Fed is popping the stock market to direct investors toward bonds due to the supply issue in 2019? Might be. You hit on it. You hit on. There's definitely going to be a lack. There's definitely a lack of supply right now. We know as the credit markets shrink, that's going to continue to be a problem. Right now, I kind of get the feeling that there was an opportunity for the Fed this week to come out and say, look, we're going to take a more measured approach. We're going to slow down these rate hikes. But they didn't. I mean, I guess in some way or another he did, but it wasn't the main focus of what the headlines were about. It still seems like the Fed's fairly determined. My thing is that if the markets are going down in the first quarter, there's no way that the Fed's going to come in and raise interest rates again. There's just no way. But anyways, the boot camp is a really great opportunity. Like I said, come in. There's a lot of different traders that are going to be scheduled to be part of it. Everybody's going to come in, have an hour. Maybe we'll have a couple guys come back. And then also what we'll be doing is we'll be displaying some of the MrTopStep products and rooms and stuff like that. Good time to catch up on what's going on with the markets and with what's going on at MrTopStep. But anyways, listen, I want to thank everybody for coming in. I want to wish everybody a happy holiday. What is that, Jerry Seinfeld? Happy Festivus to you, Marlon.
Yeah, happy Festivus.
And happy Festivus to everybody else. Can you, we're going to send out the recording. Anybody that signed up for the webinar will get a copy of the recording. For the people on YouTube, Marlon, how will they get it? Oh, they'll have a copy because they'll be
on YouTube and
on YouTube.
Yeah.
Okay. So anyways, thanks a lot for coming in and helping out, Marlon. And I like this Zoom. I like this format.
Yeah, this is our first time in this Zoom thing. I like it too.
Yeah.
Okay.
Well, listen, how many people were on YouTube?
We got up to it's late at night, so I think we got up to like 40 at one point.
Oh, that's cool. That's cool. Yeah. We got to announce it a little bit more. But anyways, have a good night, everybody. Happy trading to you and happy holidays.
Good night, Danny.
Good night.